Welcome back. Today, we're tackling a critical phase in every home buyer's journey, the period after you've secured that golden ticket, your home loan pre-approval. Congratulations are in order if you've got one. That letter from a lender is a powerful tool. It's a vote of confidence, a budget blueprint, and a serious bargaining chip when dealing with sellers. But here's the truth most people don't realize. A pre-approval is not a guaranteed, unconditional green light. It's more like a promising first date with the bank. The final commitment, the formal approval, still depends on you maintaining the financial profile they said yes to initially. I've seen too many excited buyers stumble at this final hurdle. They get the pre-approval, start celebrating, make a few seemingly innocent financial moves, and then disaster. The loan amount gets slashed, the dream property slips away, and in worst-case scenarios, they're left facing financial penalties. It's heartbreaking and entirely preventable. So, in this episode, we're going deep on the 7 things you must not do between getting your pre-approval and the final settlement of your property. Consider this your essential financial holding pattern checklist. Let's get into it. Landmine number 1, playing musical chairs with credit cards. This is a huge one. Your pre-approval is based on a snapshot of your liabilities, which includes any available credit limits. The temptation might strike. You see a fantastic new credit card offer with massive reward points, enough for a flight maybe. You think, my loan is pre-approved, so this won't matter. Wrong. Applying for new credit triggers a hard inquiry on your credit file. Your mortgage lender, during their final checks, might see this and get nervous. Why are you seeking more credit now? Has your situation changed? It could prompt them to reassess your entire application. Suddenly, your smooth process hits a bureaucratic speed bump. Equally dangerous is closing an existing card, especially if it's your oldest or only one. You might think, reducing my total credit limit will help my borrowing capacity. And in a vacuum, you're right. But the act of closing an account, particularly a long-standing one, can negatively impact your credit score. More importantly, to a cautious lender, it can look suspicious, like you're shuffling debt around. The golden rule? Keep your credit profile static. No new applications, no closures. If you absolutely must do anything, have a transparent conversation with your broker or banker first. Landmine number 2, tweaking your credit limits. This is a subtle extension of point 1, but it deserves its own spotlight. Let's say you have a credit card with a $10,000 limit. You're about to make a large purchase for $3,000 and think, I'll just call my bank and increase my limit to $15,000 for more points and flexibility. Seems harmless. Here's the brutal math lenders use. They don't assess you on your current credit card balance. They assess you on your total available limit, assuming you could max it out at any moment. Why? Because you can. Now consider the interest rate difference. Credit card debt costs 20 to 25% PA. A mortgage's 5 to 7% PA debt is much more expensive on a card. So, when you increase your limit by $5,000, the lender doesn't just deduct $5,000 from your potential home loan. They calculate the servicing cost of that $5,000 at the high credit card rate over a short term. This calculation can reduce your borrowing power by 4 or 5 times that amount. That $5,000 limit increase could cost you $20,000 to $25,000 in home loan capacity. It's a disproportionate penalty. Leave those limits exactly as they were when you got your pre-approval. Landmine number 3, shaking up your employment. Your income is the cornerstone of your loan. The pre-approval is based on your current job, your current salary, and your current employment type. This is not the time for dramatic career shifts. Do not resign. Do not casually switch from a full-time, permanent role to a contract or freelance position. Do not switch industries if it means a probation period or a less stable income history. Even going from a salaried role to the same role, but with a significant commission-based structure, can raise questions. Lenders crave predictability. A probation period is a red flag. It represents uncertainty. If you're planning parental leave, especially unpaid leave, discuss the timing with your broker. A sudden drop in provable income can derail everything. The bank's logic is simple. If your future income isn't as secure as it was a week ago, you're a higher risk. Hold steady until the keys are in your hand. Landmine number 4, Receiving unexplained large sums of money. You might be receiving a gift from family for the deposit or transferring funds from overseas. This is common. The problem isn't the money itself. It's the paper trail and provenance. Australian lenders have strict anti-money laundering and counterterrorism financing obligations. Large, unexpected deposits into your account can trigger alerts. If you use an irregular or unregistered remittance service to bring money in, the risk is higher. I've seen cases where accounts were temporarily frozen for review right when funds were needed for settlement. A nightmare scenario. The solution is transparency and documentation. If it's a gift, get a signed gift letter from the family member. If it's from overseas, use reputable channels. Keep every receipt and transfer record, and be prepared to explain the source. Your broker can often advise on the cleanest way to structure this. Surprise cash is for birthdays, not for mortgage applications. Landmine number 5. Major, buy now, pay later, or interest-free purchases. You found the perfect couch, or maybe a new car. The retailer offers a sweet, interest-free for 36 months, or buy now, pay later deal. You have the cash, but you think, I'll keep my cash liquid and use this free credit. In the eyes of a modern lender, these commitments are increasingly treated like mini loans. Even if they don't charge interest, they represent a recurring financial obligation. Services like Afterpay, Zip, and others often now appear on credit reports. A lender will see this new commitment and factor it into your living expenses and liability assessment. It signals that your financial commitments are increasing just as you're about to take on a massive mortgage. It's a poor look. If you can pay cash and it doesn't decimate your deposit or savings, just pay for it. Avoid entering into any new credit contracts, regardless of how interest-free they seem. Landmine number 6. Moving your deposit/savings around unnecessarily. Lenders love genuine savings. This typically means funds that have been sitting in your account, accumulating steadily for at least 3 months. It shows financial discipline. Your pre-approval is often contingent on this deposit being ready. The mistake here is playing hot potato with your deposit money. Don't lend $20,000 to a friend for a quick turnaround. Don't move it all into a risky short-term investment. Don't shuffle it between multiple accounts in a complex web that's hard to trace. If you need to move it, say, from a savings account to a transaction account for easier access, keep the audit trail crystal clear. A single, documented transfer is fine. A series of transfers to and from different people or entities is not. You must be able to prove the money is yours. It's been yours, and it's ready to go. Landmine number 7. Changing your residency or visa status. This is crucial for expats, temporary residents, and new migrants. Your loan pre-approval is often specific to your visa class. Different visas have different lending policies, interest rates, and even maximum loan-to-value ratios. If you change your visa, for example, from a temporary skilled visa to a partner visa, or if your permanent residency is pending, you must inform your broker immediately. The pre-approval might become invalid. Furthermore, changing your status from an Australian tax resident to a foreign tax resident by moving overseas has huge implications. It can affect your eligibility to buy certain types of property. For example, established homes may subject you to Foreign Investment Review Board, also called as FIRB, rules and fees, and can change the loan products available to you. Any planned move or visa change must be discussed with your finance and tax professionals before you proceed. So there you have it. The 7 financial landmines to sidestep after your home loan pre-approval. To summarize, freeze your credit profile, stabilize your employment, document your money, avoid new debt, protect your savings, and maintain your legal residency status. It's a period of discipline and patience. Think of it this way. You've run 95% of the race. This is the final sprint. Don't trip over something you could have easily avoided. Your future homeowner self will thank you. If you have questions about your specific situation, always go back to your mortgage broker or banker. Full disclosure is your best friend. Thanks for listening. If you found this helpful, share it with a friend who's house hunting. See you next time.